For decades, Southwest Airlines operated by a completely different set of rules. No assigned seats, 2 free checked bags for everyone, and a famously simple fare structure. They ignored standard airline practices and thrived anyway. By putting the customer experience first, they built fierce brand loyalty. Passengers actively chose Southwest to avoid the stress and hidden fees typical of air travel, consistently making them the friendliest brand in the sky. But this chart, mapping recent financial returns, reveals a harsh reality. While legacy carriers recovered and grew, Southwest has consistently fallen behind its higher-performing competitors. That persistent underperformance caught the attention of activist investors. Over the last year, shareholders argued that the airline's traditional operational model was no longer sustainable, pushing for a pivot toward aggressive revenue growth and shareholder returns. They delivered a strict ultimatum. Southwest had to overhaul its business model to maximize return on invested capital, a metric tracking how efficiently a company uses its cash to generate profit. The alternative was a hostile boardroom takeover. Management chose to comply. To survive in today's ruthless financial landscape, Southwest is dismantling the corporate identity that made it a household name. This map of North America illustrates the first major change: aggressive capacity management. Southwest is actively shrinking its network, eliminating flights to international destinations like Cancun and significantly reducing its footprint in major hubs like Atlanta. Passengers haven't stopped wanting to fly. Instead, management is actively cutting underperforming routes to chase higher profit margins, consolidating their remaining planes into high-demand hubs like Nashville. Every route decision now revolves around a core industry metric: revenue per available seat mile, or RASK. This formula divides total flight revenue by the number of seats and miles flown to calculate exactly how much money each seat makes. By refusing to spread their fleet across every possible destination, Southwest ensures their planes only fly routes with strong pricing power. This guarantees higher load factors, meaning fewer empty seats on every single flight. These route cuts are a calculated optimization play. Southwest is shrinking its overall footprint to guarantee that every plane in the air generates maximum cash. Southwest is overhauling its passenger experience, moving away from the egalitarian cabin structure that defined the brand for 50 years. This cabin seating chart shows how Southwest is dividing up its aircraft. The open seating era is over. The cabin is now segmented into tiers, introducing assigned seats and premium extra legroom sections for those willing to pay more. The universal bags fly free policy is also gone. Moving forward, passengers buying into cheaper fare classes will be hit with a standard baggage fee at checkout. Management is intentionally introducing these points of customer friction to mirror the exact pricing playbooks used by legacy carriers like Delta, United, and American. For years, those competitors have generated billions of dollars in pure revenue simply by charging extra for the amenities that Southwest gave away for free. Southwest is surrendering to industry norms. They are adopting the highly lucrative strategy of charging passengers individually for every minor comfort. Yet, when Southwest announced these aggressive pro-profit changes, doing exactly what activist investors demanded, the stock price actually dropped. This dual-axis chart illustrates a stubborn airline industry paradox. On Wall Street, any announcement reducing future flight capacity is viewed as an immediate red flag, signaling slowing near-term growth and economic uncertainty. Investors refuse to reward a company based on promises. They want to see hard earnings data proving these operational changes actually work before they buy back in. The era of the Southwest anomaly is ending. In its place is a modernized, standardized business model that looks increasingly similar to its legacy competitors. Management is taking a massive gamble. They are actively alienating their most dedicated base to adopt the exact same aggravating pricing structures as their rivals. Curious, can Southwest successfully extract billions in new fees without destroying the fierce customer loyalty that built their empire in the first place? By prioritizing financial optimization over brand differentiation, Southwest is betting that the billions in projected new revenue will outweigh the risk of becoming just another airline.